Hello, I wanted to record another problem from variance analysis. So this is chapter 8, dealing with flexible budgets, standards, and variance analysis. Ultimately, we want to be able to calculate 8 different types of variances. The first pair are direct materials variances, quantity and price. We want to be able to calculate direct labor, efficiency, and rate variances. And we want to calculate variable manufacturing overhead, efficiency and rate, and fixed manufacturing overhead variances, volume and budget. There's a lot of steps before and a lot of steps after, but as I mentioned in class, one of the very first things you need to do is be able to calculate predetermined overhead rates. So what I would like to do is go over problem 8A, that's from the appendix in chapter 8, problem 12A, and this is in your textbook and it's on page 392. You do have the solution. I photocopied the entire solution for you so you can follow along with the problem and follow along with the solution. I'm assuming you've read the problem and you're familiar with the fact pattern. So let's take a look at it. The problem is set up in such a way that the given information, there is one section on budgeted information, there's the second section on the standard information, and the third box deals with the actual information. So the first step that I'd like you to go through here is to calculate the predetermined overhead rates. You're going to have a predetermined overhead rate for variable manufacturing. You're going to have a predetermined overhead rate for fixed manufacturing overhead, and then obviously when you add the two together you'll have a total. And as you recall, the predetermined overhead rates are calculated from the budgeted information. So that's going to be from that first box, and you're looking for the budget numbers. And the first box tells you that the budgeted variable manufacturing overhead is $34,200. They also tell you that the budgeted fixed manufacturing overhead is $63,000. The denominator value is exactly the same for both of these items, and they tell you that the denominator activity in direct labor hours is 9,000 direct labor hours, DLH. So therefore, the predetermined overhead rate for variable is going to equal $3.80. For the fixed is $7 per direct labor hour, and the combined is $10.80 per direct labor hour. So step number one, you need to be able to calculate the predetermined overhead rates. And the thing that is absolutely important, and the primary purpose for calculating predetermined overhead rate, is that the that's not working very well. The predetermined overhead rate equals the standard price to be used in preparing, number one, the standard cost card, and secondly, to calculate the variable and fixed manufacturing overhead variances. So that's the first thing that you need to do, is to be able to calculate the predetermined overhead rates. The second step in variance analysis, as I've pointed out to you, is that you need to be able to prepare and fully understand the standard cost card. That is the standard cost card, which is made up of direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead for both quantity, price. And we want to calculate cost per unit. The problem gives you a lot of information already, and they tell you that the quantity for direct materials is 4 pounds at $2.60 a pound. for a total of $10.40. Obviously, quantity times price equals cost per unit. With regard to direct labor, it's 2 direct labor hours. The labor rate is $9 per hour, and the cost, the direct labor component for each unit is $18. They also tell you in this problem that manufacturing overhead is applied on the basis of direct labor hours. So you still have the same 2 direct labor hours here for manufacturing overhead. And as I indicated a few minutes ago, the price, the standard price, this is standard obviously, standard price, standard quantity. We calculated the predetermined overhead rate for variable to be $3.80. That is the predetermined overhead rate for variable. And we calculated the fixed predetermined overhead rate, PDOR fixed, at $7, resulting in $7.60 and $14. The total cost per unit in this problem is $50. You need to be able to prepare in detail the standard cost card, breaking out both the variable manufacturing overhead and the fixed manufacturing overhead. Let's start calculating our variances now. You have the standard cost card available to you, and you're going to use that to calculate your standard cost. Let's take a look first at direct materials. In the format that I've suggested you work with is standard quantity times standard price, actual quantity times standard price, and then lastly the actual, which is actual quantity times actual price. First, look at direct materials. Now in this problem, they give you the facts and they tell you under the actual information that materials purchased were 30,000 pounds at $2.50, and they later tell you that materials used in production was 20,000 pounds. And remember what I said, when there is a difference between what is used and what is purchased, AQ is different. When it comes to calculating the quantity variance, AQ is what was used. So in this problem, they actually produced 4,800 units. The standard quantity is 4 pounds per unit. They should have used 19,200 pounds. What did they actually use? They used, and this is why it's important, they used 20,000 pounds. So you can see there's a difference between what they should have used at standard 19,200 and what they actually used at 20,000 pounds. At the standard price, it's $2.60, $2.60. These totals are $49,920 and $52,000. The difference between these two numbers is your quantity variance, which in this case is $2,080 unfavorable quantity variance. Let's look at what was used. In this case it's different. AQ becomes what was purchased. So AQ is what was purchased here. The quantity that was purchased. And that was 30,000 pounds. Times $2.60. In this column we have a number, $78,000. The actual, 30,000 pounds, times the actual price, $2.50. Notice there's a difference between the actual price at $2.50 and the standard price was $2.60. It's a 10-cent savings. This number is $75,000. The difference between these two numbers here is your price variance, which is $3,000 favorable variance. Favorable price variance. Again, this is a problem where the amount used, $20,000 is different than the amount purchased, $30,000. That's your direct materials variances. Let's go on and let's look at direct labor. Direct labor variances. Again, we have 4,800 units. It should have taken 2 direct labor hours per unit. You should have used 9,600 hours at a standard price of $9. This column is $86,400. The actual number of hours, 10,000. So you can see there's a difference. They should have used 9,600. They used 10,000 hours. They're 400 hours over at a standard price of $9. This number is $90,000. The difference between these two numbers here is your efficiency variance. This is $3,600. And you can see that is going to be an unfavorable variance. If we look at our rate variance, 10,000 hours, their actual rate, $8.60. This number is $86,000. This is our rate variance here. And you can see we have a $4,000 favorable rate variance, and that is because they paid them $8.60 where the standard was $9, 40 cents savings over 10,000 hours. That is your direct labor variance. Let's take a look at the variable manufacturing overhead. Variable. Again, we still have the same 4,800 units, 2 hours each for 9,600 hours, but the standard price is the predetermined overhead rate, $3.80. That is your predetermined overhead rate for variable manufacturing. That's why you calculated the predetermined overhead rates at the very beginning of the problem. This number is $36,480. The actual quantity we saw in the previous calculation, 10,000 hours. Standard price is still the same, $3.80. This number is $38,000. The difference between the first two columns is the efficiency variance. $1,520 unfavorable. $1,520 unfavorable variance. Let's look at the actual cost. Well, in this problem, they gave us the total actual cost at $35,900. You do not need to know AQ and AP, although you can find them. You don't need it because they give you the actual number. This here is our rate variance. And our rate variance is $2,100, and that is a favorable variance. Those are your variable manufacturing overhead variances. Let's take a look at the fixed manufacturing overhead variances. And as I've said before, you have to be careful when you're calculating these variances because these are slightly different. This is for fixed manufacturing overhead. Fixed. We still use the standard number, but the middle number is going to be represented. This is going to be the budget dollars, and this is going to be our actual dollars, both of which are provided to you in the problem. Again, the standard calculation, 4,800 units times 2 hours each, 9,600 hours. But what is the standard price? The standard price is the predetermined overhead rate that you calculate at the very beginning of the problem. $7 predetermined overhead rate for fixed manufacturing. Total of this number is $67,200. Compare it to the budget number at the beginning of the problem, $63,000, and the actual amount, $64,800. No AP, AQ, no AQSP, just budget and actual. Difference between these two numbers here is the volume variance. This volume variance is $4,200 favorable. Difference between these two numbers is our budget variance, and that number is $1,800 unfavorable variance. Those are the calculations of your 8 variances that we've talked about. Let's erase this. The other thing that you need to be able to do here is to look at the manufacturing overhead T account for total manufacturing overhead. And what you want to remember is that the debits in this account represent the actual costs. The credits in this account represent the amounts that are applied to work in process. But this is standard applied. What are those numbers? The actual cost, which we saw before, for variable manufacturing overhead, $35,900. The fixed piece, $64,800. That amount totals to $100,700. The standard applied variable, $36,480, and the fixed, $67,200. If you want to know where those numbers come from, go back and look at your 2 variance calculations under the standard, and that's where they come from. The credits in this account total $103,680. We need to look at our net debits and our net credits. We have a net credit $2,980, $2,980, and that represents over applied. Over applied manufacturing overhead. The other thing that I asked you to do is you should be able to summarize all variances, and specifically you should be able to summarize your manufacturing overhead variances. You have variable manufacturing overhead variances of $1,520 unfavorable, $2,100 favorable, and you have your fixed manufacturing overhead variances of $4,200 favorable and $1,800 unfavorable. Those 4 numbers net out to be $2,980, and you can see that that is a favorable variance. You'll notice these 2 numbers agree to each other. An over-applied manufacturing overhead, over-applied, represents a favorable variance. The other thing that I'd like you to be able to do is to prove out that volume variance. You can see there is a favorable volume variance right here of $4,200. What does it represent, and why is it favorable? Let's talk about that. Let's look at the actual production in units. Actual production in units was 4,800 units. That was the actual production. But what did they budget? What was the budgeted production? What was the budgeted production? They don't really tell us. They don't tell us what it is, but we can surmise, because they had 9,000 they had 9,000 direct labor hours. They budgeted 9,000 direct labor hours at the very beginning of the problem in the budget section. They also told you that it takes 2 direct labor hours per unit. Therefore, we can surmise that they had budgeted to produce 4,500 units. If you'll notice, to use your math, 4,500 units times 2 direct labor hours per unit, they would have required 9,000 direct labor hours. That's how they came up with their denominator value. They started with an expectation of producing 4,500 units, and they knew, according to their standard, that they needed 2 direct labor hours per unit. That's how they came up with their denominator value of 9,000 units. In this problem, they produced 300 units over budget. They required direct labor hours per unit times 2, 600 hours at a fixed manufacturing overhead, predetermined overhead rate or standard price of $7. You can see they had $4,200 favorable volume variance. Whenever the actual volume is greater than the budgeted volume, you will always have a favorable variance. And that's exactly what happened here. They budgeted 4,500 units. They sold 4,800 units. Therefore, they had a favorable variance. And one of the last things that you need to be able to do in this chapter is to be able to identify and explain significant variances. Let's take a look at some of the significant variances that occurred in this problem. The very big one, you have a direct materials quantity variance, which was $2,080 unfavorable. What happened here? They actually used 20,000 pounds. The standard was 19,200 pounds. They should have used 19,200. They used 800 pounds more than they should have. At $2.60, that is a $2,080 unfavorable variance. They used 800 pounds too much. What is the corrective action? I would suggest job training of their employees so they don't waste as much. There's a chance they wasted material. They needed to keep an eye on that. What is another significant unfavorable variance? In this problem, again, we're looking at unfavorable variances. Another unfavorable variance here would be the direct labor efficiency variance. From looking at the problem, the standard, they should have only used 9,600 hours. They actually used 10,000 hours. Again, 400 hours more than they should have used. At $9 an hour, you can see $3,600 unfavorable variance. Again, I think you can make the argument that these employees need some job training. Job training will allow them to become more efficient. So in this problem, it looks like their direct labor employees need some more efficiency and need to know how to use their materials better. That is essentially the problem here. All of these problems will be slightly different. What we need you to do is do some critical thinking. Good luck. Thank you.